Hi, folks. Welcome back to Code and Concrete, where we share the latest trends and the stories of trailblazers in the built environment. I'm your host, Matthew Schneider, the CEO at Building Inc. Joining me today, I have Chris Lehman. He's got nearly a decade of experience working in data analysis and management consulting for healthcare and tech companies. He studied political science and economics at Harvard University and has been engaged in independent policy research and writing since graduating. He leads Groma's policy department, managing policy research initiatives, building relationships with external partners in government, academia, business, and journalism, and advising the company on long-term policy goals and elements of systems design. Sounds like this is going to be a pretty academic conversation. Chris, I'm glad to have you on the show.
Yeah, great to be here. Thanks for having me on, Matthew. Excited for this conversation.
We first got acquainted at Boston Blockchain Week, which was about 9 months ago. We were on the Brick by Block panel, if I'm correct, talking about how we're going to bring real estate on chain. And I think that's going to be the big topic for today, how to do that, some of the legal structure that has to go into it, the technical requirements, because there's definitely a right and wrong way. But it seems like you guys at Groma have had success lately.
Yeah, that's right. Yeah, it's been a long road. There's been a lot of learning along the way. We do have some great lawyers on team and some great lawyers advising us, and we've taken a pretty conservative approach to putting real estate on chain, which I think has not been universal among people who are trying to do this. But yeah, happy to talk about all the legal and regulatory side of things, and then just the fundamental idea of why real estate should be on chain, why Groma coin specifically, various elements of our approach.
Yeah, so we'll unpack some of that. First, I want to learn a little bit about your journey coming out of Harvard University and then getting into the tokenization space. How did you get here?
Yeah, great question. So I studied, as you said, political science and economics, was really interested in large systems, competing incentives, how to design good structures for incentive alignment. I went and worked on applying those in a few different industries, starting in healthcare in a pharmaceutical consulting firm in the Boston area, advising drug manufacturers on pricing strategy. Then moved on to work at Wayfair, working between the business and tech side of things, doing data analysis, figuring out ways to create better incentives for the operational teams, and then design better tech systems to help them achieve those goals better. Throughout this whole period, I was continuing to look at the policy side of things, doing a lot of research, doing a lot of reading, writing down some of my thoughts on my blog. That led in early 2020, right around the time the pandemic hit, to me reconnecting with one of my good friends from high school, Seth Prebatch, who had previously founded Level Up, which is a payments company that he sold to Grubhub in 2018 and then went on to lead most of Grubhub for the next 3 years. And as we were looking at the quantitative easing that was happening, right, money printing in order to keep the economy running while everything was shutting down, we really became more bearish on the dollar and its long-term stability than we had been previously. We had been looking at the blockchain space for a long time, made some purchases, done some experimenting, but hadn't gotten that deep into it at that point, but really started taking it more seriously at that point and figuring out and kind of thinking from first principles about how would one design a really stable currency for the long run, given that we don't expect the dollar to continue to do that in perpetuity. I had taken a great class while at Harvard with Neil Ferguson, who some of your listeners may be familiar with. He's a professor of history, but with a focus on financial history, economic history, and had given a really nice overview of the history of the evolution of currency. And so it was drawing on that basis and thinking about different modes of designing currency from the past that ultimately led me and Seth to land on real estate as the backing for currency. It's a huge asset class, easily has enough supply to be a global reserve currency. It's stable relative to the dollar, stable relative to stocks. Not, one-on-one, I'm saying lower volatility than stocks, but also a better store of value than the dollar and most fiat currencies. And it has this unique or close to unique property whereby its value is strongly correlated with economic activity going around near it, which makes it able to expand and contract naturally without a central coordinator alongside the overall volume of the economy. So that and a few other factors led us toward the idea of real estate as being the ideal backing for a currency. And then over the ensuing 9 months, we continued workshopping those ideas. We wrote the white paper together over the first half of 2021. And I've been on team full time since then as kind of a jack of all trades, working on a lot of long-term strategy stuff, running the policy and government affairs side of things here, which is important both on the housing front as we deal with a lot of local and state level policy, and then on the financial services front as we deal with DC on blockchain specific stuff.
So Groma isn't just handling real estate and tokenizing it. The Groma coin has a unique element. It almost wants to act as a stable coin that's backed by real estate to reduce the dependency on or to have natural economic activity. This varies by market. And right now you're focused in Boston. So how do you make it less correlative to the Boston market and more nationally stable and consistent? I don't know if I phrase that appropriately.
And that gets at kind of our longer launch trajectory and different stages of the company and of how Groma Coin works. So today, as you pointed out, our real estate holdings are all in the greater Boston area. So we're a great barometer for demand for real estate in Boston, but not as much for Miami or San Francisco or Houston or any of these other markets out there. And so today, really the primary reason you would want to buy Groma Coin, right, the on-chain tokens that represent our REIT shares, is you believe in the value proposition of Boston real estate and specifically the unique asset class that we've been developing here. Longer term, though, we're going to be expanding everywhere, right? We'll be expanding first likely to other markets in the Northeast, and then as demand grows, expanding into other markets. And so there'll be a kind of gradual evolutionary process of focusing on real estate as an investment and as a traditional asset class, and then becoming more commoditized as we move forward and acting more as a stable coin and as a general index of real estate in the longer run.
Okay, that makes sense because at scale, real estate becomes far more diversified, which would parallel the effects of a stable underlying asset class that you want, adverse to maybe some of the other collateral options that are out there. And I agree with that fully. So it's more of a long-term play that works out. And I think it would be difficult to do that upfront, one, given the state of where tokenization is as a technology, but also you have to source all of the real estate. And as I understand this REIT, well, because it's in a REIT structure, you or Groma owns all of the real estate. It's not like a listing platform.
Correct. Yes. So all of the real estate is owned by Groma and Groma's investors. We've structured it as an opco-propco model, meaning we have the operating company, the tech company, Groma Corp, that builds all the tech, that does all the property acquisitions, management, et cetera. And then we have a bunch of different vehicles that hold our real estate. So the main one, and the one that's relevant to the blockchain side of things, is the Groma REIT, which is an evergreen vehicle. And then we have a bunch of different closed-end funds for specific theses. We have various tax structuring vehicles as well, many of which will ultimately end up feeding into the Groma REIT as they close down and the REIT acquires their properties. But the REIT is the main one here. And I guess also an important thing to note on the subject of where we are today and the long-term goal of a real estate-backed currency, an important feature of the currency is not just stability of the assets backing it or of the token itself. It's also that people are willing to buy and sell denominated in that currency. And that's not something you can achieve overnight, right? You need a huge network of people who are holding the currency and who know it and understand its value in order for that to start working, right? And so that's one of the biggest barriers to overcome and really demands that we have a strategy for getting Groma Coin into the hands of as many people as possible for reasons other than its utility as a currency. And we can talk about that in a moment when we get to rent vesting. But that's an important trajectory and shift that is part of our story.
And the properties that constitute the REIT, are these income producing, stabilized assets?
Income producing, yes. Stabilized, there's a mix, right? Most of the assets are stabilized or close to it, and then we're constantly onboarding new assets as well, where we typically have a varying degrees of value add in the early years, where the specific asset class we look at, small unit count multifamily properties, are often in neighborhoods that are experiencing a huge amount of demand, but there's assets that are really physically not up to the standards of the people who want to live in these neighborhoods, right? So if you're familiar with Boston, the triple deckers here, many of them are 100 plus years old, and many of them have not been excellently maintained in the course of that period. And so we'll often buy them and put a lot of work into making the interiors of the buildings, a high quality living experience that's at the standard of people who want to live in these, dense, walkable, highly desirable neighborhoods.
Right. Redevelopment opportunity. So naturally, then Groma coin would be yield bearing. Is that right?
Yeah, that's right.
That's awesome to be able to transact potentially in this currency, but then to hold on to it, because that's what a lot of people dislike about current stablecoin alternatives or even the fiat. It's uncompetitive.
Right, exactly.
It sits there. You have to deploy it, but
so it's a blended return profile, which is pretty common for real estate, right? You have a portion of it coming from the distributions that the real estate gives off, and then part of it from the appreciation. And so, obviously, it varies across funds, and it varies across individual properties, but we tend to target a mid to high teens IRR, and that's a blend of the distributions and the appreciation.
To accomplish something like this, it seems like tokenization is really one of the only viable vehicles to wrap real estate in a sort of instrument that could be held, transacted as a currency, whatever you want to accomplish with it. Is there anything else that Groma was trying to get out of real estate or tokenization of real estate? Because some people talk about operational efficiency, transparency, the new innovative creative financial instruments, which is what you have here. Is there anything else that's on the radar for you guys?
Yeah, so you've hit on a bunch of the key themes, and making efficient transactions viable for rent vesting is a big one. There's a lot of ways in which real estate's return profile is really well suited to the DeFi ecosystem. A big issue in many DeFi applications is the need for really high and unfavorable collateralization ratios, because the assets that are being used, that are being staked, are so volatile. Real estate's much less volatile. And so you can get away with lower levels of collateralization, and at the same time, you're getting yield on that. So it's really well suited to a lot of the needs of the crypto environment today. And while things like fractionalization are already accounted for by the existence of REIT structure and REIT shares, there's a lot of efficiencies and niches that can be filled by having REIT shares exist on chain as well.
I agree, and it's good to point that out, because the typical use cases of tokenization are not so evident here, or at least it doesn't rhyme with what most of the thought leaders, and I'm going to actually put that in quotations, are talking about, because it's not about fractionalization or easy distribution. As soon as you have an SPV or a REIT structure, you abide by the existing private or public securities laws, and it's been set up for successful capital markets for the most part. And you don't necessarily have to put something on chain. And it's the more niche instances of the technology like this that I think really make use of its capabilities in a way that traditional technology could not. And therefore, it generates legitimate and long-term alpha. It's not dependent on people misunderstanding the technology or misunderstanding existing securities laws. You guys are experts in that. And you say, we actually understand where the errors are and how it can be innovated upon, and we're going to roll that out successfully. And it seems like you guys are doing okay. If you can disclose, what's your AUM at this point, or just how well is the REIT doing?
Yeah, so I guess two separate questions, and you can think about those in a few different ways. But before I get to that, I do want to talk a bit more about something you alluded to, which is how we think about our strategy on the tokenization side differently from other real estate tokenization plays. You see a lot of real estate tokenization projects out there that are that are geared towards specific assets, right? You might have one property, and the pitch is, hey, like previously you wouldn't have easily been able to own, say, 1/1000th of this property, and so we're going to tokenize it, split it up, and be able to do that. That's an approach, right? And that's something that a REIT wouldn't typically do because the upfront costs of getting a REIT rolling are actually pretty high, right? We're talking about probably low millions of dollars just to get the paperwork through the door. And that's something that you can certainly do. We tend to think, A, that doesn't work for a currency because there's no building that's big enough to support a currency on its own. And B, for the vast majority of investors out there, especially retail investors, it's not going to be optimal to focus on just one specific property and have to do a huge amount of research into the unique characteristics of that property and how you expect it's going to do over the next 5 to 10 years. You want a broader index, you want diversification, and that's what we're ultimately planning on providing. And then the other side of things too, and this is a concept that's been getting a lot of attention in the past few months, as we're seeing, in Washington, there's a more permissive attitude towards crypto and towards tokenization in general, such that some people are looking for ways to use tokenization as a way to get around securities regulation and issue a token indexed to some other asset and expecting that that token will be immune from those regulations. And there's a practical sense in which that might kind of be true for a while if the administration's priority is not enforcing stuff in the crypto space, then you can't necessarily count on that for the long term. But this is something that Commissioner Hester Peirce of the SEC, who's been a longtime friend of the crypto industry, has talked about explicitly. She's said that these kind of second order security tokens are receipts for securities, which is already clearly defined as a security, right? It's not a get out of jail free card. It's not a magic incantation, you can say, and be exempt from securities regulations. And so, we did a lot of work in the early days, back in 2021, 22, going through a lot of this theorizing and coming up with the conclusion that, hey, this is clearly a security. It's expectation of profit from the effort of others. There's really no way around that. And so since we're in this for the long haul, we're going to start a REIT. And so then getting back to your question at the end there, which is, how's the REIT doing? What's our AUM? How's our performance? Honestly, going very well. So our total real estate portfolio at this point, and this includes both the REIT and some of our other vehicles, is somewhere in the ballpark of $350 million worth of real estate in the Boston area right now. Again, performance varies across the different vehicles. We at different points had low 30s, high 20 IRR. Other vehicles are in the high teens. It's hard to give a precise answer on the overall performance since we measure these things in different ways, and some of them have specific tax advantages that are not shared in kind of the headline IRR. But broadly, real estate's performing well, and we've fundraised successfully off of that.
Speaking of Washington, take a step back. In the past week, for those of you who don't know, two massive acts just passed. There was the Clarity Act and then the Genius Act, and an anti-CBDC as well. Chris, what do you think the impact of those acts could be on a company like Groma?
Yeah, great question. So I'll start with the Genius Act, which is the one that has gone through both the House and Senate and been signed by the president into law. Genius Act is the one that lays out the framework for stablecoins. It is geared specifically towards fiat-pegged payment stablecoins, right? So while what we're doing is, in a sense, a stablecoin, it's not explicitly the target or the subject of the Genius Act. Now, what we're building will really benefit from having players that are able to confidently operate with dollar stable coins interacting with us, right? Groma coins do yield dollar denominated distribution streams, and to the degree that those can be done via stable coins rather than via fiat, that's great for us and leads to all kinds of downstream positive impacts. So we're really glad to see the Genius Act pass for this reason. The Clarity Act, which is the market structure bill, it's more or less identical to FIT 21, which was the market structure bill in the previous legislative session. That one has now passed the House, but still hasn't gone through the Senate. So hopefully it'll be signed into law later this year. that one's also going to be huge, and that's primarily on the. And I guess I should mention briefly just what it's expected to do. Basically, it delineates how you define different on-chain assets as being either securities or commodities, and therefore whether they'll be regulated by the SEC or the CFTC, which has a bunch of different implications, and mostly comes down to the degree of centralization of the entities that manage the protocols on which the token runs. So the more centralized you are, the more likely it is that your token will be designated a security. The less centralized, the more likely it'll be a commodity. And then there's a special separate clause for payment stablecoins. So, those categorizations are not, again, relevant to Groma, or at least they're not any change for Groma, because what we've been doing has always been a security. There's no question there. It's a read share. But where it becomes interesting is that you have a lot of these big, institutional, responsible, law-abiding players in crypto that are, have been clearly waiting for a long time to be able to offer securities on their platforms. Won't name any names here, but you can probably, infer who I'm talking about. And once these rules are out there and clearly established, it'll make it much easier for them to onboard products like Groma Coin that are securities, and for which there's a huge amount of demand that they clearly have been setting themselves up to tap into, but have been, both because of the regulatory ambiguity and then also previously under the Biden administration, the kind of capriciousness of the Gensler SEC, have not done yet, just because they're dispositionally more conservative.
An open-ended question for you, but on the topic of tokenized real estate and policy, are there any blind spots right now? And is there anything that you'd really like to see resolved? Any current bottlenecks or something that we should be advocating for in order to advance this particular tokenized asset class?
Yeah. Good question. I guess here I would, to some degree, reiterate my previous point around people being a little bit too optimistic about the potential for various types of on-chain real estate to be considered not securities. Really, what I would say here is, unless you're managing the property yourself, it's probably security. And most people who are trying to make money in crypto don't want to be, fixing toilets or, giving tours for rentals. And so while obviously you can talk about all the reasons it might be good for society to have a less regulated environment for that kind of investment, under the rules we have today and will likely continue to have for many years, securities are how you should be thinking about on-chain real estate.
Mm-hmm, mm-hmm. This came to mind. This wasn't on the agenda for today, but looking at the advancements in policy in Dubai in particular, where it bypasses the SPV model and goes right down to the property deed level. Mm-hmm. Do you think that that's something that would support tokenization, help it scale, help adoption, or is that really just an unnecessary advancement? Because there's people on both sides of the aisles who say, well, we like the SPV model. It has its benefits. Yep. Whether it's the terms that can come together or the protections and the different tranches that are available. Others say that this is a major step forward for the industry, and it, one, shows government adoption, but two, cuts out intermediaries that, or uses technology to cut out intermediaries. What are your thoughts on this, if you have any opinions?
Yeah, no, so I and Groma broadly believe in deed tokenization as a pretty meaningful win that likely is still decently far in the future in the U.S. as an actual operational improvement. I know there was a pilot to some degree. I think it was in northern New Jersey. One of the either counties or towns there did a partial deed tokenization at their registry of deeds, and there's been some discussion of that here in Massachusetts as well with one of the local registries. Government moves slowly here, and merely tokenizing deeds would be an improvement, from a transparency and legibility perspective, but wouldn't have huge implications for what you can actually do with those. Where I think you would ultimately see more benefit from that kind of initiative would be if you can help that be the architecture to bridge the registry itself to all of the other layers of government functioning that are built on top of the registry, primarily taxes, right? If you have the assessments and the taxes being done on stablecoin rails, being done more programmatically, transparently, efficiently, you can really see some of these older governmental functions that have not gotten a lot of attention, rationally so from the perspective of policymakers, because there hasn't been a lot happening in that up until these newer initiatives. You can really see efficiency gains, transparency gains, better governance if you can have the secondary layers that are built on top of the actual records of property ownership integrated well into the tokenized deeds.
100%. If you tokenize in a silo, the technology cannot do much. It thrives on the systems effect, essentially, because that's where programmability actually applies. Two different things that would be unrelated might now be responsive to one another and done so without human intervention. Whereas the traditional way would be multiple departments, multiple people involved. So if just one department tokenizes, you haven't accomplished too much. And that's the big challenge in the US, where we are highly fragmented in our government bodies, because, say, deeds are handled at the county level, but then also the software that's being developed and rolled out, you have different companies, they might not be interoperable. So it's a tricky solution for sure, but that's where the real value is. And whoever develops the solution to that is going to be very successful just because of the scale of the issue that exists. So looking at Groma, you guys have something called rent vesting. I'd like to get into that. Can you tell us what that is?
Yeah, so rent vesting is, I think, one of the most interesting projects we're working on right now. And it came from us looking at the real estate industry broadly, and how in basically every sector of real estate except for renting, leverage plays a huge role, right? If you want to buy your own home, you take out a mortgage unless you're extremely wealthy and can just pay for it in cash outright. If you are in commercial real estate, you're also usually going to be applying a pretty healthy dose of leverage to your properties in order to improve capital efficiencies, returns, et cetera. But if you're a renter, you're really just throwing money into rent every month. You're getting something out of it, right? You're getting a place to live, which is very important, but you're not building any durable assets, and you're not leveraging, both in the literal and figurative sense, that steady payment stream of often many thousands of dollars a month into building anything for yourself. And we think that renting, which is an activity that is worth $650 billion annually in the U.S., should have a mechanism to help renters build equity in the real estate around them. And that's where the idea of rent vesting came from. The way rent vesting works is, if you're a renter, instead of paying, let's call it $2,000 a month in rent to your landlord, instead, you would buy $2,000, an equivalent amount of shares in the Groma REIT. You would then take out a loan from us, which is, transferred from our lending partners, and use that loan for an equivalent amount, again, $2,000, to pay your rent. So at this point, you're in the position where you've paid your rent, same as before, a little bit more circuitously, and you now have offsetting $2,000 worth of equity in the REIT and of debt. So your net asset value to begin with is zero. And we've tried to structure this in a way such that the renter has as little risk as possible. Really, it's just risk of Groma Corp itself and not the assets themselves. So instead of the renter paying the interest on the loan, Groma Corp does. Instead of the renter getting the dividends from the REIT shares, Groma Corp takes those dividends, uses them to pay off the interest. And what the renter ends up with is exposure to upside in the Groma REIT shares. So if over the course of the year, the REIT shares appreciate 5%, and you've put in, let's say $10,000, 5 months worth, you'll get, $500 worth of appreciation on those shares. You could do as much or as little of that as you want. Do it for many years. You could do it for just 1 month. The longer you put it in, ideally, the better it'll do. Obviously, no guarantees. Real estate values go up as well as down. On average, they tend to go up. You can fill in all the normal disclaimers there. But at the end of the day, what you're left with is basically an option on the value of the real estate as a renter. That's not that's not formally how it works, but it's kind of economically how it works. So you, the renter, are getting upside based on the appreciation of the real estate. And Groma Corp is basically left with the task of making sure that the dividends and then the other fees we earn from management of the real estate that's being added to the REIT are enough to pay off the interest. So we have a pretty complicated set of economics there, but the renter has a pretty straightforward value proposition where they gain if the real estate goes up in value, and they're at worst neutral if it doesn't go up or if it goes down.
It's an interesting structure, that's for sure. And I think people are going to have to hit the rewind button and listen to that again to process it.
Yeah, this is something where we're still, we're setting up the MVP website right now. Our wait list will be going live probably in August, and then enrollment will open up probably Q2, Q3 next year.
How much of this do you think could be automated by a smart contract?
Yeah, great question. So yeah, I mean, this is for sure where we're going with it. In the early days of it, this will still be implemented on TradFi rails. Humans will be doing a lot of the record keeping, which is pretty tedious. I'm actually personally running the record keeping for the internal alpha of rent vesting that we're doing for our employees and some early investors right now, and it's pretty tedious. So really looking forward to the point where that is actually going to be implemented via smart contract using the tokens will be transferring all the Groma REIT shares onto over the coming months.
Well, speaking of numbers and data, another spur of the moment question, and it's actually a callback to your introduction, because you have some experience in data analysis.
Yep.
And I personally think that the relationship between data and tokenized real estate is an important one. It's currently underappreciated, but data is the driving factor for the success of something on chain. It's very important to have some sort of pipeline or flow of data from the real world on chain, or else our securities that we are creating are by the day growing more distant to what's happening in reality.
Right.
There's more data asymmetry, therefore more risk. How is Groma taking into account data in the tokenization of real estate equation, if we want to call it that?
Yeah, great question. And so that gets to a lot of work that we've done on building out a behind the scenes tech platform to run our real estate ecosystem in general, even blockchain agnostic. These are many small properties spread out across the metro area of Greater Boston. We have over 100 properties today. In order to accurately and effectively maintain those properties and to report to our TradFi investors, we need to have really well built out data pipelines and aggregation going on, right? It's more challenging for a given value of property than it would be if we just had, one or two 300 unit buildings, big apartment towers. And so we've already put a lot of work into building out data pipelines such that our internal team and our investors can see detailed metrics on how buildings are performing and how we're expecting them to go in the future. And so transferring that over to blockchain requires more development, obviously, but the fundamental pipelines are in place, and the transparency provided by the property NFTs. And I guess this is something I haven't explicitly mentioned, but in addition to the fungible tokens that represent shares in the Groma REIT, we also have non-fungible tokens that represent each individual property. And so today you can go on the Groma website and you can look at the NFT for 108 Calendar Street or 122 Gladstone Street or any of the properties in our ecosystem and see all of the math that goes into our valuation that's itself based off of our data, right? Revenues, costs, interest rate, et cetera. And so, yeah, you're absolutely right that in order for people to confidently invest in real estate on chain, there needs to be good data, there needs to be transparency, and we've put a lot of work already into making that the case.
So in some way, the NFT is like a data room for the property?
Yeah.
Okay.
It's a good way of thinking of it.
Yeah, there's a really good relationship between the data and the valuations that you're creating and the tradability of the assets on chain, because if you want to use it as collateral, if you're depending on it as a currency and there's reserves involved, there's a lot of it ties back to the appraisal process and how well that process is performed, because those numbers, even if they're just on paper, ultimately allow or disallow the movement of capital. And as you tie in different lenders and DeFi and institutions, they get very heavily involved, and they have their own policy as to what's appropriate, what's the right amount of risk, and what numbers they like. And so being able to present that, and it seems like it's auditable because it's on the blockchain, so that due diligence process is accelerated. Really great. And it's one of my favorite questions when talking about tokenization. Like, what is your data and digitization process? Because it's really the foundation for anything that goes on chain. You want data-driven tokenization. You really can't have tokenization without it. Otherwise, these securities that you're creating are just hollow wrappers. They're shells of what a security could be, but are laced with risk and opacity. I mean, the real potential of tokenization is that fluidity of information to capture it, aggregate it, process, clean it, and then act on it. And once you get into like agentic workflows, they need data. AI doesn't have any other context or emotion to make decisions. It's only going to be nearly binary, or at least confidence scores, and that means numbers have to come in. So this is great that Groma focuses on that, and one of the reasons we're having this conversation.
Yeah, no, and this is an area where, obviously, again, people in the crypto space often complain about the SEC, and some of those complaints are warranted. But the idea that, in order to facilitate capital formation, you need to have really robust disclosure about how the assets are actually working is a sound one, right? And if the norm were one of more opacity, you would see a lot less propensity to invest in this space.
Especially as we look big picture and you start not just on a national level, but cross-border, if you don't have some sort of framework in place for analyzing assets and almost standardizing them, like understanding the inputs of the valuations that we're dealing with, if you don't have that, there generates a lot of confusion. And we're not going to see the full potential of blockchain-based distribution without some sort of comparable framework like that. Because if we are sitting in two cooling markets, if our assets are sitting in two cooling markets, and we're not thinking about those variables, but we're saying, well, they're on opposite sides of the country. Well, that's introducing new forms of risk. So there has to be some way to measure that, and you can layer this as well: the asset health and performance, the markets, micro and macro markets, as well as the financial instruments and the risk and reward associated with the terms that have been assigned to it, and then ultimately the smart contract, which sits on one blockchain. You mentioned that you're blockchain agnostic. Is that right?
We have had a lot of conversation about what's the correct blockchain to choose. We are currently on the Sepolia testnet right now and are working on a mainnet launch slated for later this year, probably in Q4. We are leaning somewhat towards the broader Ethereum ecosystem, but haven't made a formal announcement on what the mainnet launch will be at this point.
Yeah, well, it's tough to pick a blockchain because you have to think about liquidity. Like, blockchains are not made equally, and they have variance in the fees as well as the amount of volume on chain. And that's something that, if you are just working with a traditional market maker or alternative trading system, might not be completely relevant. Whereas if we're on different chains, we have to ask, is it interoperable? How many wallets are active? How easily can they transact? And still factoring on top of that, market making concepts like what's the spread?
Right, exactly. Yeah, no, and this is something that we're putting a lot of work into right now as we prepare for the mainnet launch, as we prepare to actually have fully on-chain transactions going on for retail investors, which are, again, dependent on our Reg A+, which is a specific type of securities offering that we'll be doing, again, probably around Q2, Q3 next year. But we're working on getting all of the pieces set up ahead of time, both baseline blockchain token development, as well as the partnerships with market makers, with exchanges, et cetera, so that when we go live, there is sufficient liquidity, there is sufficient participation in trading the token. We've had a lot of good conversations there, and ultimately what we expect it to look like is there'll be two two broad categories of how you'll be able to buy or sell the token, and then within one of those categories, kind of plethora of different options. Option one is primary issuance and redemption, meaning directly with Groma, right? So you can you will be able to go to our Prime wallet and exchange USDC or Bitcoin or Ethereum for Groma coin directly from us, which results in new Groma coin being minted. You'll also be able to take Groma coin that you have and exchange it back for those tokens, right? So redemption of those securities, which either puts it into our treasury or nullifies the tokens, depending on the situation, depending on our discretion. That's one way you can do it. The other way will be on the secondary market. And so either that'll be directly with other retail market participants or with a variety of different market makers, whether they're kind of more traditional market makers or automated market makers and liquidity pools, that sort of thing.
Mm-hmm. Right. Well, transitioning out of the technical discussion, and it's phenomenal what you guys have designed, in my opinion. I don't get to have such a sophisticated conversation with everyone. Not all platforms are approaching this the right way, but the data-driven approach, I think, is going to succeed long-term, and those with compliance in mind. And that's clear, and you deal with policy. So it's clear that you guys are going to excel there. But taking the foot off the gas, I want to ask you more of an entrepreneurial question. What sort of advice would you give to startups that want to build in this space, which is, despite what the hype might suggest, actually far more regulated and legacy heavy? What sort of advice would you offer to startups or founders?
And so, but by this space, you mean specifically on-chain real estate?
I would say yes. If you want to open it up to other asset classes, you could, but real estate.
Yeah. I mean, I guess our early learning process was very driven by external counsel, specifically our external securities counsel. And I'm not a lawyer. My wife's a lawyer. I a little bit of exposure to that side of things, but definitely not on the security side. My co-founder Seth, has previous experience in public markets and in that world, but is also not a lawyer. And so we were very dependent early on external security counsel in telling us what we would and would not be able to do. And some of that advice was very useful, and we definitely got exposure to a lot of relevant concepts through it. But I think we had not appreciated at that point the degree to which even really big, sophisticated law firms are still, at least, and this is 4 years ago, so I'm sure it's changed to some degree today, but there's still a lot of making things up as people go along, and just because you've paid somebody a lot of money to tell you something doesn't mean that is ironclad truth. And so we avoided any pitfalls there, but I guess my advice to founders here would be conservative in terms of risk, and to the degree that you can, be scrappy and find less expensive ways of getting that information.
There's a Steve Jobs quote, which is that the world as we know it was created by people who are no smarter than us. And for those of us building at the forefront of technology or tokenization, blockchain, it's really evident that these systems, legacy, they might be and outdated. I mean, there's pros and cons. Some of it was intelligently designed. Some of it's just been broken for a while and people didn't want to overhaul it, or they didn't have the capability of doing that. And those whom we seek wisdom from in navigating policy or innovation, right, when we build products or going to market, might not have the full picture, or might not be up to date, or are still stringing it together. So I think that's just really good advice in general. And I think maybe the solution, depending on risk tolerance, is to go out and break things, right? That's what they say, like just go out, try to break through the wall and see what you can accomplish, because it might just be a facade in some ways. You think it's a restraint, and really it's just status quo for no real purpose. But as we wrap up here, to get off my philosophical soapbox, Chris, I want to give you a call to action. Who should be getting involved with Groma and how?
Yeah, great question. And that's going to, depend on a huge amount of different things. We're at a point right now where the vast majority of our actual dollars raised for our real estate vehicles has come from institutional investors. And so if you are an institutional investor, we'd love to talk to you on that front. But, our goal is to build a real estate backed currency. And in order for that to be the case, we want hundreds of millions, eventually billions of people to own Groma coin, to hold it, to buy it, to spend it. And that is going to take a lot of work. It's going to take a lot of word of mouth. We think that, as I said at the beginning of this, holding a lot of money in fiat is not a winning proposition. You want something that's stable. You want something that is durable, that is well understood, that is understood broadly, not just you individually, but by people worldwide. Real estate's really well suited to that. And so, again, we're not open to non-accredited investors yet, though we expect to be next year. And one of the most exciting things that we're doing for any of your listeners who are renters is rent vesting. If I were a renter, I would be absolutely all over it. Most of our team who are renters are in fact participating in it and loving it right now. And so in the next few weeks, and I'm sad that we don't have this up yet, but very soon we'll have up our rent vesting website where you can sign up for the wait list. It'll be rentvesting.groma.com. It'll have a lot of information, more than I've given on this call so far. And you'll also be free to email me, chris@groma.com, or our rent vesting specific address, rentvesting@groma.com. But honestly, I think for most people who are interested in the utility of real estate on chain, signing up via rent vesting will be a great way to participate in it in a relatively low risk way. Obviously, you'll be able to just buy the asset straight out, but I think rent vesting is really the most exciting thing, most exciting way for probably most of your listeners to participate at this point.
Okay. Very cool. Well, I will have some of your contact information and links to Groma in the show notes so that people can scroll down and check that out. Otherwise, Chris, this has been a really good conversation for a lot of reasons. I value the approach that you have to tokenization, and I think it's almost a North Star for other tokenization projects, at least in principle, to adhere to policy and compliance, technical capability, and being very considerate of the economics of tokenization and the underlying real estate. It's a very complex relationship that all of these have. But for those who appreciate systems thinking, which is absolutely required, I mentioned that before at the software level, but you need meta systems in a sense, a system of systems. And I think you appreciate that, and those who do are going to succeed in this industry. So Chris, thank you for the time today and teaching us about Groma and tokenization, and not to make it binary, but maybe the right and wrong way of approaching it, or at least...
There are definitely wrong ways. Yeah, I can say that.
Yeah, at least a more strategic way to approach that.
Yeah, no. Thanks, Matt. It's been really great talking with you. Thanks for having me on. Yeah, this has been a really interesting conversation, and I appreciate providing the forum for having broader conversations around the intersection of on-chain operations, real estate, and broader real-world applications.
Absolutely. And a big thank you to all of our listeners who have tuned in. And if you enjoyed what Chris had to offer, please reach out to him, get in touch. If you enjoyed the episode, 5 stars on Spotify or Apple is much appreciated, or like and subscribe on YouTube. Helps all of our guests that we have on. Well, thank you very much, Chris, again, and everyone that tuned in, and looking forward to the next time.